afternoon I have Sunaina Sinha, who is Global Head of Private Capital Advisory at Raymond James. Sunaina, welcome.
Thank you so much for having me.
It's great to have you here. So let's get straight into it. Is now a good time to buy?
This is going to end up being one of the best vintages for private equity in a generation. Think about the economic backdrop that has preceded 2023. We've had record moves upwards in markets, and almost all participants in private equity, investors, their limited partners, the entire ecosystem has been complaining about valuations. What we have now at the start of 2023 is the public markets have come down, and so the comparable valuation set has come down quite dramatically. At the same time, you have quite a bit of flight to quality happening with investors looking to only buy the best assets and sectors, whilst also having a backdrop where fundraising is not going to be easy for anyone and everyone that comes to market. So what does that mean as a whole? That there will be private equity capital to deploy, but only in the best businesses bought at the best price. Otherwise, deployment will be slower. So this is one of these vintages where if I were a limited partner investor in a private equity fund, I would think to myself that this will be a vintage like the post-GFC, Great Financial Crisis period, where you had some of the best returns in private equity because private equity had capital to deploy, was doing so smartly, was able to pick its spot, had more supply of companies than it needed to get its deals done, and so was able to get in at the right entry valuations.
And are there any sectors that are offering better opportunities?
Sectors tend to follow the asset picking, stock selection style of private equity. There is no question that there are certain sectors that are more resilient to economic downturns, inflation, and crises in general than others. So what are the sectors that benefit from the kind of macro environment that we have, which we know a lot of mid-market private equity funds are dialing up in their portfolios if they are able to do so? First amongst all of them is services, especially tech services businesses, where you have a lot of recurring revenue in the companies, you have a lot of forward revenue visibility. For most tech services businesses, they already know what their revenue profile in 2023 is going to be, making them an incredibly good buy and hold strategy for economically challenged periods. What a better business to own than one in which you know exactly how much money is going to come in that year to a high degree of confidence. So they are certainly winners in this environment. Other business services, industrial services, continue to be a great preference of investors. Healthcare services businesses are also always going to be in the sweet spot of what investors are looking to do in this environment. Any business that requires a high degree of operational value add is where private equity excels. I'll answer the flip side. What are some of the sectors that are more challenged today, where investors are going to need to see a larger degree of underwriting and downside protection to feel comfortable? Certainly consumer is one of them. We have an environment where consumer discretionary spending has pulled back in quite a meaningful way. So limited partners, when they look at consumer sector plays inside private equity portfolios, they need to see a high degree of confidence that demand slowdown is not going to impact those businesses.
And you talk about visibility. What can investors do to increase visibility on their economic outlook?
I'll go back to an old tenet about private equity. Private equity is all about company selection, stock selection, asset selection. And while private equity is very cognizant of what happens in macro, it is very focused on what's happening in the micro. So the best thing a private equity investor or one of its limited partners can do is to look at GPs who are picking companies that outgrow the economy significantly. So for example, if you have your economy around you is growing 2 or 3 or 4% and you have businesses growing 15%, that's a great win, right? Even when the price of debt is 7 to 10%, but you have a company that's growing 15%, you're winning and outpacing the cost of debt. So the most important thing investors can do is look deep into the portfolio and think about how robust is the company and what is its growth profile. If it's outgrowing the economy and if it's outgrowing what's happening in the credit markets, you have a winner in your hands. The second thing investors can do is certainly to keep an eye on what's happening to the consumer. At the end of the day, no matter what your business, at some point there's an impact the consumer has on you. Even if you're a services business, eventually what happens to your customers is driven by what's happening to their customers. So keep an eye on what's happening to the consumer. How hard or soft is the landing, the economic landing from what's happening in the rate tightening world with central banks around the world? That is something all investors have a view on. Third thing is to think about what's happening to liquidity. Liquidity at the company level, liquidity at the fund level, and liquidity at the investor limited partner level. All three matter. At the limited partner level, their amount of capital they have to spend on private equity commitments is determined by what's happening in asset allocation overall in their pension plan, endowment, or foundation. And certainly at both the fund and the company level, liquidity is very important as well. It's to make sure that there's no counterparty or credit risk. At the company level becomes very important in challenging economic environments.
And what can investors do to really stress test companies beyond the usual due diligence process?
One of the things investors are doing more now than ever before is really to think about what kind of structuring they can put in place when they buy businesses. So what are the kinds of downside protection mechanisms that can be built in to their purchase price on the way into a business in 2023 or an environment like it? So these days you're hearing a lot more about earnout structures. You're hearing a lot about liquidation preferences. You're hearing a lot about different structuring solutions to give the incoming new buyer and owner of a company more downside protection than we have seen in a previous environment. That's the first thing. The second thing that certainly investors are doing to stress test their scenarios is just that their rate of return requirement in this market has gone up than it was in the past. Whilst they may be looking for a 3 times business, in the past they may have to slice that to 2.75 or 2.5. These days, if they want 3 times growth, it is 3 times growth. They're not taking any shortcuts to that. And of course, in addition to that, you have an environment where they're going to be stress tested by the credit providers in these businesses. The banks, which are so far still very shy in terms of providing liquidity, but certainly the direct lending private credit industry is stress testing these businesses even more so in terms of downside scenarios and putting covenants in place in the debt to make sure that those downside scenarios don't come out of the woodworks. So for an incoming buyer of a company, running all those tests in advance and having the answers to those questions becomes very important.
And do you think we are or can expect to see more secondary transactions?
Without a doubt, the biggest, fastest growing place for innovation in financial services today is secondaries. What we've seen in the last 2 years is record deals being done in the market, over 100 billion in 2022, over 130 billion in 2021. That will continue. We will continue to see a market that's over 100 billion for many years to come, and certainly going towards that $1 trillion mark in the next 8 to 10 years. In private equity secondaries, you have innovation at 3 different levels. You have innovation at the asset level or company level, innovation at the fund level, and at the management company level of the GP. And all 3 are important. At the asset level, everyone's heard of continuation vehicles. Most of our clients, who are some of the largest and best known private equity funds in the world, will tell you that a continuation vehicle is a mainstay of their exit options alongside M&A and IPOs. So a continuation vehicle has been established now by all the leading players in the market as a regular way to create liquidity for your investors. Same thing at the fund level. You see more and more funds now running tender offer processes, NAV financings, preferred equity financings at the fund level, again to give more liquidity back to investors and also provide more liquidity for portfolio companies to grow. And these days, especially over the last 5 years, you've seen much more innovation at the GP financing level, that there are lots of NAV facilities for GP commitment financing, for GP stake sales than ever before. So all 3 parts of the cycle work together here in terms of creating liquidity solutions for general partners, and we will continue to see that to be the case in the future.
That's fascinating. Sunaina, thank you so much.
Thank you.